Welcome back to Focus Fridays, the series where we open up the playbook on real estate investing, focusing on foundational concepts all the way up to the sophisticated strategies that help investors grow wealth with confidence. I'm Jared Shum, head of investor relations here at Focus Capital, and I'm joined again by our head VP, actually, of investments here, Chad Olson. Chad, always a pleasure to have you back.
Good to be back.
We've talked a lot about, you and I have talked a lot about deal structure, underwriting, the capital stack. Those are some of the episodes that you have graced us with your presence on during this series. But today I kind of want to go a little bit deeper on that. And something that sits on the foundation of almost every deal is the debt. So the debt is a piece of the capital stack that we mentioned before. Specifically, I want to talk about what loan types are available for investment properties. How they differ, and why does the choice of loan structure matter so much to deal performance and investor returns? Because of what I think not a lot of first-time investors maybe might understand is that debt isn't just a line item on the pro forma. It can sometimes be a strategic decision that affects cash flow, risk, flexibility, and ultimately what investors receive at the exit. So breaking everything down from there. So before we get into specific loan types, why should investors care about this? Because what if they think a loan is a loan, right?
Yeah, but it goes into kind of the center point of your question that loans are, at the end of the day, it's just debt. And then people kind of simply understand it, that you're going to have these fixed payments that you're going to have to make over the defined period of that loan, however that's structured. But depending on the type of loan has huge impact potentially on, to your point, like either cash flow or potential returns at the back end. And you're choosing which one you want along with certain portions of risk. And it's kind of those three that you're calculating. Okay, what returns am I looking for? What is my strategy here? And how much risk am I willing to take on to get to those ends? And those are the things you're balancing between the different loan products, along with, what the property itself or you as a borrower can qualify for.
Yeah, I think the biggest thing that people think of first off is the cost of capital. So like the interest rate. I think everyone who knows anything about any type of debt, consumer debt, knows that there's some interest rate associated with it.
Yep.
The next kind of stuff that I would probably touch on is like what you said, the cash flow stability, fixed rate debt creates predictable debt service, floating rate creates variability. Sometimes there's more flexibility in certain loan structures than others, which also can affect refinancing and exit timing. And part of our thesis and business plan here for a lot of our properties is to look at a refi at the end of year 2, beginning of year 3. And so I think it's important as we kind of go deeper into this subject for people to remember that a loan isn't just financing. It's like a structural element that's integral to the deal, especially when it's a majority of your capital stack.
And it generally is the majority of the capital stack, almost in every case. Yeah.
Yeah, I would say at least 65, if not 70% is pretty typical.
Very typical, yeah. Yeah, you'll see some people that like to bring it down to 50s, but that's not usually normal. And again, it comes down to the strategy that they want to hold onto these assets.
Yeah, and I think debt in a general rule of thumb, sometimes people think it's a bad thing, but we talked in a previous episode with Chad Sheeler about how we leverage debt, like why we don't buy deals all cash and hold it for all cash. And I think that there's certain scenarios, and this could be a whole nother episode, or where it's appropriate to purchase a property all cash up front, but then refinance it pretty immediately with a debt structure and cash out some of that capital, just because it's like, from a returns perspective, you have a lot more risk if you're putting all cash in there and you're not able to leverage all of these tools, which I view a loan as a tool.
Yep.
Can you go into what agency loans are and when they're used?
Yeah, so agency is usually referred to as perm debt. Agency is any of the government-backed service lenders, which can include Fannie and Freddie, and then also HUD loans. Each one come with their own parameters, their own cost and benefits to them and stuff. HUD is kind of the big long-term one. So if you're a long-term holder, it's the most interesting just because you get 35+ year amortization. You are going to get some of the better proceeds that you would see, but it comes with private mortgage insurance or mortgage insurance on those usually. That's come in pretty strict prepay because they're planning on for you to hold it for like 10 years plus. So you need to be ready when you take those loans on to keep it for the long-term horizon. And it also comes with inspections and other things that some people don't really like, and a very robust underwriting process on the front end. It takes 6 months to close. The agencies are the normal perm that people are taking on in most cases for the investments that we're doing, because they have terms from anywhere from 5 to 10 years. And they have some inside of that, but that product hasn't been being used very much. But they provide the cheapest cost of capital across the spectrum, them or HUD. And so you're going to have the lowest spreads over whatever the prevailing treasury is, where banks and other institutions are going to be, I wouldn't say considerably higher, depending on the size of the loan, and that has power in itself too, but they're going to be the best. And then they're also going to give you some of the more favorable interest-only terms and all the other stuff. The underwriting is tight and a process more than what a bank would put you through, but it's not that, it's only marginally different.
Yeah, speaking of a bank, I didn't want to go too far into bank loans because I think a lot of people are familiar with a bank loan structure, whether it's for a multifamily asset, a car, etc. Why wouldn't someone choose an agency loan? That all sounds better, especially with a cost of capital perspective. Like, you typically can get better interest rates because they're government backed, they're non-recourse loans. Why would someone, we've chosen bank loans over agency loans as a first loan before. Why would someone choose a bank loan over an agency loan?
A variety of reasons. It comes down to strategy. Like I said, it's usually referred to as permanent debt. And so you want an asset that is already stabilized to be able to get the max amount of leverage, because it's only going to be based off that property. So when you're buying a property, if the owner isn't extracting all the value or has very high expenses or whatever else like that, you might be able to walk away with 50% leverage. Well, you're locked into that for the term. A bank might give you a higher leverage on it because they can see what you're planning on doing on the pro forma. Same thing with bridge debt, debt funds. I mean, there's plenty of options out there. And again, it comes back to the strategy. So if your strategy is to take over a property and then improve it, then you probably want to take down bank debt or bridge debt in the first part and then transition to permanent debt. When we bought some of our newer assets, they are already there, right? So the upside is in just operations and the cash flow portion of it.
Yeah.
It's not so much in the leverage in the beginning. The bank's not going to give us much more because we're basically leveraging it at 70 to 75% anyway. The bank's not going to get over their skis, even with that pro forma sizing. So it's better for us to go in with that on the agency side in the front end. But when we're doing our value add ones, we go straight to a bank because they're willing to give us some CapEx dollars, they're willing to give us this other stuff. And then the flexibility 2 to 3, 4 years down the road to refinance into that permanent debt and then reset the value, return some capital to investors, and do all those other things.
Are there any prepayment restrictions that are pretty typical when it comes to an agency loan versus a bank loan?
It's all an ever-changing environment, right? Depending on where the market is. So you generally are going to see with the agency, it's going to be yield maintenance defeasance or the minimum of 1% of the outstanding loan balance at the time of the prepayment. So they just want to collect their interest.
Yeah.
And then on the bank side, it can sometimes be the same thing, but generally you see a lot of 5-3-2-1 step downs over the course of whatever that term is. So it just depends. But on the bank side, it's very much negotiable. We've generally gotten every one of the bank deals that we've done signed up, set up so that we don't pay a prepayment penalty if we either sell it or go to permanent agency financing. The only time we would pay it is if we went to another bank. So.
Yeah. I think it's interesting that you said about the stabilization requirement, how agency lenders typically require the property to be stabilized or typically at a 90% occupancy or above for a defined period of time. I know that kind of varies sometimes before they'll even lend. And since a majority of our portfolio are value add deals or typically we have one that it was a development deal, like those kinds of loans just wouldn't have applied to those situations. But when we've looked at refinancing, we go from a bank to potentially an agency loan because we've stabilized the property. That's also good context for people that are in different types of assets, even if all of their assets are technically multifamily. Different asset classes affect the type of loan or a debt structure you have. You mentioned bridge loans. If agency debt is the permanent financing solution, what fills the gap during the execution phase of a value add deal, and how does that bridge loan work? And typically, what are pretty standard terms when it comes to like the deals that we do?
So bridge is kind of a loaded term in itself because technically the bank financing that we're taking down is bridge debt as well, but it's structured in a way that looks much like any of the agency stuff. There is a category out there that's just called bridge lending that usually comes with the moniker that, you're going to have a 2 to 3 year term on it with some extensions in it. But the bridge lending is going to give you better leverage, higher leverage. It's going to give you also a higher rate that goes with it. So it goes into all these different types of loans, and there is a lot of different ones, and then they get kind of broken out, whether you have balance sheet lending, off balance sheet lending, and all these other kind of things. But with a true bridge loan that's going to come from a debt fund, that spread is going to widen quite a bit.
Yeah.
So suddenly you could be talking about 3 points, 300 bips, or 3 percentage points over whatever the prevailing treasury rate or SOFR. Generally, it's SOFR. So the SOFR rate right now, and that's another part of it with the bridge lending that's been in the last couple of years, but that SOFR rate is in the threes right now, mid high threes. Obviously, that's going to change every day, but you'd be looking at high 6s to 7% rates in that. It's going to be variable. It's going to be floating rate. You can use swaps and some other technical things to be able to reduce your risk in that, but that's generally how they're going to structure it. And you'll have 2 to 3 years to execute your plan. You'll get interest only during that whole period. And so, but that spread's pretty high. With a bank, you can bring that spread down to 200 to 250 with some different tools at your disposal. Both of them will give you increased leverage. They might get you to, a bank would get you to 70, 75. Debt fund bridge thing would get you maybe to 80, 85 in some cases if you wanted it. And then there's another tranche of like CMBS debt too out there that you can use as kind of a hybrid between bank and agency as well. Those ones, it usually works again for stabilized assets more than anything else. It works for a lot of portfolios. People like it for that. Those things you usually can get tighter spreads on the right assets. And then you can also get full term interest only through the whole period. So some people like those products and they've come kind of back into vogue. I think they went away for a little bit. The people weren't loving them, but they're coming back pretty hard. They're getting aggressive. But again, it just comes down to the strategy that you're looking to implement.
Yeah, I think it's important for investors to understand that the need for a bridge loan isn't always a red flag. Like it's a product for a reason. It's traditionally made for transitory periods of time on, like you said, interest only. It does come with a higher rate, typically SOFR plus spread, like you were mentioning. But there are a lot of extension options. There's a lot of prepayment flexibility in there. And I think that while it's more expensive, it provides the flexibility needed for execution phases of a deal. And then there's also ways where that actually might be the best strategy versus bank or agency debt. You had mentioned 2 other forms that I kind of want to tap into, and then I'll let you decide which one you want to go into first. But there's 2 types of bridge loans. There's the ones through bank and the one through a debt fund. Want to go into debt funds as well. And then you also mentioned CMBS. Let's start with debt funds. What are debt funds and how are they relevant? And I can kind of speak to the IR side of things because those have become a much more prominent part of lending, of the lending landscape. And so how do those fit into how you evaluate as someone who is on our acquisitions and investment side? When do you consider those?
They're just we haven't done them. We haven't used them. And I don't really foresee us using those because the banks have kind of met the market where they need to, and the debt funds are just kind of out there. I think that they were a product of 2020, 21, 22. There's a lot of the private credit world, but I think that they've transitioned to different things. I think that they're looking at other asset classes, but multifamily luckily is very, like, even to all that stuff you said about asset classes, it's like Fannie and Freddie are not in any other asset class except for multifamily. So the market itself benefits from the access to capital through various debt markets, and through that creates competition that gives us the best terms. So when it comes to the debt funds, we see it, we look at it, we assess it, and it really only starts to get interesting or become a possibility on assets that have a lot of issues. To that point, a lot of upside. So we're getting it for the right price. It doesn't underwrite. The banks can't get behind it. This can't get behind it. No one can get behind it, but a debt fund can see the thing and work through execution to get there. That being said, for the deals that we've looked at and gotten really close on that are like that, the banks usually meet us where we need to be met. And then those terms are a lot better. So we haven't gone the debt fund route. With the debt fund, sometimes you can get non-recourse out of that, but it's just 50-50. You just don't know. It depends on the group. Really, the only true non-recourse for sure is at the agency level. But there are some products out there that provide that to reduce risk on the
I think this
sponsor.
is such an interesting product for our investors, particularly not just because of what you evaluate, but because we actually have a debt fund here. It's called the Focus Capital Income Fund. So it's a private lending vehicle. Most debt funds are private lending vehicles that are typically managed by a private equity firm or specialty finance companies. And they provide real estate loans that are backed either by institutional capital or even private capital that has been pooled together rather than deposits or government backing. And the way that we use this bridge loan lending here is very short term. So when you were talking about bridge loans that we've considered, those are 2 to 3 year term. We're talking like a matter of months for our bridge loans. And that's not a red flag for people that need that gap financing. It's typically because we can move faster than a bank when it comes to our underwriting process, but there is a level of risk in there, and that's why the upside is so high. And so we've talked about in many episodes, you get compensated. I mean, there's a risk premium. You get compensated based off of your risk factor. And so we do our due diligence here. We make sure that there are borrowers within our network, people that are just like, I only need this for this 30-day window. And they're not able to get it done from a bank, not because they don't qualify, but just because of a timing thing. They need to capitalize on their time. And then we kind of set a thing of like a 90-day minimum interest portion. We won't lend out more than 6 months at a time and certain check sizes. And so there's definitely the opportunity and the competition there to push for that type of product. And so it's not an automatic red flag if someone needs like I said, bridge loans or debt fund financing, but it just has to be the right fit on both sides. Want to kind of transition back to what you had mentioned before about CMBS loans. For people that don't even know what that acronym stands for, like it's a commercial mortgage-backed security. Where does that fit? When do you use that type of product? Why has it been created, and have we ever considered those here?
Yeah, we've considered them. Again, they kind of underwrite the same way that an agency would, that they need to see the actual operations bearing fruit, but they might get a little bit more aggressive in the fact that they'll look at trending to give you those proceeds and everything else. The spreads are going to be higher. They're going to be more in line with bank, but even maybe a little tighter. And then the interest only is where the real power comes from, because they have no problem giving you full term interest only for most of those products. Whereas agency or bank or whoever is going to kick in with an amortization payment at some point, probably 2 to 3 years into whatever the loan is, depending on the loan structure. So those are the real advantages of them. The power in those comes from scale. So you need to be lending, they need to be putting out money of like 20, 30, 40, $50 million in debt proceeds to really get interesting. Anything below that $30 million is usually not very interesting to them. Mm-hmm. So you see it a lot more with portfolios and everything else. But there's generally flexibility. The yield maintenance and defeasance comes back into play on those a lot of the times. And then non-recourse.
Yeah. What is the most common debt-related mistake that you see in deals overall when you're evaluating deals?
I don't know. It depends on how you want to frame that, right? Like we could look back 3 years, 5 years to what was going on and coming into after COVID, and obviously what's playing out now, which is a lot of people taking on bridge debt when they shouldn't have. And it's so easy. A lot of people can do it going back and saying, well, that was wrong. But to think that at the historically lowest rates that we've ever had, that they would stay there or go any lower when they were effectively negative, then was kind of crazy to think. And to underwrite deals accordingly and then take on that risk didn't make a ton of sense. Mm-hmm. And I think a lot of people are figuring that out. But it's just like, you can make any deal work when your debt's effectively 0 or 2%, and you can pay 4% cap rates on stuff. But the second that expands, you're going to get in a lot of trouble, and that's what happened. So there's that. I think the stuff going on now is maybe for people that are not as experienced or have a difficult time with that, it's really anticipating what you're going to get. I think we lean on some loan brokers, especially for agency business and stuff. So I see a lot of that stuff giving feedback to me. But I'd never been in a position where we underwrite something that we can't hit. Like usually the debt, I'm usually pretty conservative and I can hit that number or go higher. And that's how I like to set it up. A lot of the times you'll see and hear about people that had a number and it came in way lower than that. Because either their debt broker explained something to them or they took the loftiest expectations of what those proceeds would lead to. And then they get hit on the operations appraisal or some other factor. And then not having interest rate kind of mitigation inside of your model during the period of acquiring the asset. If you're going to go fixed rate, but like there's, you know, we just experienced it, right? Like it was tough because we had a really good amount of spread in our pro forma, but it still ate it up with this ongoing war. We started looking at a deal in February or March, and the war wasn't going on. Rates were pretty good. And then 2 months later, we're in a very different part of where we've been. And now we're pushing highs again today. This week, we're pushing new highs. Or I shouldn't say pushing new highs. We're starting to tick back up, and the highs for the 5-year, I think we're like 4.6, 4.8, somewhere in there, and we're trending that way, unfortunately. So having protection there, I think those would be the two things I would say that are the risk for mistakes that people are making.
Yeah. Last question. How should investors think about the loan type when evaluating a passive deal? I know that they don't get a major decision on what kind of product is used because usually by the time that they're evaluating the deal, the debt is relatively in place. But for first-time passive investors reviewing an offering, what should they actually be looking for and how do they evaluate that debt? And what questions should they be asking about the debt piece?
Yeah, I mean, you want to understand what product they're planning on going after, right, first. And then after that, it's like, okay, how far baked are you? Because I do think that there's some people out there that probably would say they're going to do something and they're not far enough down the process like we are, but I lean very much forward on that. And we're pretty much have selected our lender before we even done LOI, but definitely through LOI to PSA. We're usually figuring that out and have a pretty good plan of it. And we have term sheets issued. So you can ask for the term sheet. That'll give you a bunch of information. But at the very least, you just need to know interest rate and whether they're choosing fixed or variable, what the proceeds are, what's going to be used for. And then I think understanding, like, you would assume that the sponsor you're dealing with has everything in order, but like some more validation ones you could go into. It's like, okay, are you guaranteeing this loan? Is someone else guaranteeing this loan? What are they getting for that? Are you charging a fee for this? Whether you're guaranteeing it on recourse, non-recourse. What is the fees getting charged to you from these different brokers? What brokerage are you using to get this done? Because that can increase cost. The term of it, obviously, and how that balloons when amortization ends. Those are kind of the things, but all that can get exposed in the term sheet. But yeah, I would say that those are probably, yeah, those are the questions.
Yeah, I think the three biggest ones that come up for us are what is the interest rate, like, which is a big one for any type of debt. What is the interest period is that sub question of that. And we usually put that straight in the deck, whether there's a 24 to 36 month interest only period. What is what is the loan term? Because especially if is it a 5-year loan? Is it a 3-year loan? Because if it's a 3-year loan on a 5-year hold, that means that we have to refinance on
or sell it at that point in time.
Sell it, yeah.
Which, yeah, so that is something that you're looking for. You need to trust the sponsor first off that you're going with, right? And you shouldn't necessarily get bogged down on whether they're using permanent bank, CMBS, bridge, financing. You shouldn't get bogged down in the fact that they're using interest only or no interest only. You shouldn't get bogged in the fact that they're taking on variable rate or fixed rate, right? Like if you as the investor have a specific thing that you're uncomfortable with, then that's just your rule. You stick to that. If you're like, I do not want to be in a deal that has variable rate financing, then that's just a criteria that you use to screen and you just don't do it. That being said, it's like, as long as the person that you're going to work with and that you trust is explaining to you why they're doing this and the strategy that they're using, then it could be good. It could be an investment. We're going to do a variable rate or this other thing at some point. It makes sense now, you know, now that we're off the bottom and we're at what has been historically in America average rates, but high in the last 20 years, there's room here to play that game. And if we think rates are high right now and will go down, if we think rates are going to go up, whatever that game is, but that's an arbitrage to start playing with the rate game.
Yeah.
It was not smart when they were the lowest. It's a very different conversation to have right now, depending on your execution and what you're doing. And so that's not, if you're comfortable with that, then like, you know, just make sure that the sponsor has a plan and a strategy of which to execute on that.
Yeah, and a big one is, like you had already said, like who is guaranteeing the loan? What kind of risk is that imposed to the LPs? I mean, our principal, Chad, he guarantees all of our loans here, and so it just also shows a lot of buy-in and skin in the game that we have to have really good deals because the bank is going to be coming after him, his house, all of his assets first, and so it shows that not only does he believe in the deal outside of his already like principal investment, but then also from the guarantee side, and that we know that it's a good deal. I think to wrap up, it's important for people to remember a couple things from this episode. It's like debt structure isn't just a line item pro forma. It's a strategic decision. Understanding the different loan types is important for our aspect when we are choosing which vehicle to use. And what each one means for the investment isn't something that LPs should typically get bogged down in. It's usually the higher level things that are, do you trust your sponsor? Do you trust the structure? Who's guaranteeing that loan? And then also the loan term. Well, how does that play into the business plan? Is that written into the business plan? Is it like, hey, we'll figure it out later? Because I think that even having a 3-year term on a 5-year hold is fine if the price is like, you know, we already know that we're going to refinance in year 2. So it's a 3-year, with the 3-year loan, we have that window of opportunity to kind of like hold or sell at year 3. So I think it's one of the more useful analytical skills for a passive investor to develop when it comes to evaluating the business plan portion of the debt. Thanks for walking us through this, and we'll have you on the next one. Thanks for listening to this week's episode of Focus Fridays. We release a new episode every week, so be sure to join us next Friday and beyond. If you'd like to see our next investment opportunity before it goes public, you can join our investor list by filling out the form on our website, focusedcapital.com. If you have any inquiries about what we've covered on our podcast, general real estate investing questions, or suggestions for the show, we'd love to hear from you. Feel free to reach out to us anytime by emailing us at investors@focusedcapital.com. Take care, and we'll see you next week.